The macroeconomic highlight of the coming week is currently scheduled for Wednesday the 12th of May in the form of the latest monthly growth data for fixed asset investment, retail sales and industrial production in China. In March, they were up 26%, 34% and 14% year-on-year respectively, although the base for comparison will get progressively harder from here onward. Another strong set of data would, however, feed into the narrative of the Chinese economic recovery, in the view that the country was first into COVID-19 and pretty much first out, while the Communist Party government and the People's Bank of China have provided fresh fiscal and monetary stimulus when needed. Chinese GDP grew 18.3% year-on-year in the first quarter of 2021, and the International Monetary Fund is forecasting growth of 8.4% for this year and 5.6% for next overall. However, this hasn't quite helped the Chinese stock market as much as you might think. The benchmark Shanghai Composite Index is up by 20% over the past year, but it still resides a long way below its all-time highs. And I guess there are four possible explanations for this. I'll leave it up to you to decide which it may be, and whether it's a combination of them or indeed down to something else. First, markets are forward-looking, and they may have already anticipated and priced in a robust recovery. Second, some might argue the economic numbers are not necessarily entirely reliable and could be subject to a positive gloss from the authorities. Third, the People's Bank and the Communist Party are already tamping down on monetary and fiscal stimulus to try and stop a repeat of the financial market bubbles of 2007 and 2015. And fourth, Sino-American relations are still pretty frosty, and under President Biden, the US continues to try and block China in behind a sort of silicon wall, as the argument over intellectual property and trade flows continues, and technology, telecoms equipment and silicon chips find themselves right at the forefront of the dispute. Again, I'll leave it to you to decide which, if any of those you feel are important, but this maybe goes to show that macroeconomics is not necessarily an ideal tool for stock picking. China's shown plenty of GDP growth since 2007, and its stock market's gone nowhere fast. Back on the home front, after the April deluge, corporate news flow is due to be a little quieter in the week ahead, although there is a long list of scheduled annual general meetings, and it's possible that they could stir more interest than usual, as issues such as executive pay come under ever closer scrutiny. On the results front, the following may be notable, either because of what they say about themselves, their industry or the economy more generally, although some of these dates could yet be subject to change. Pubs Group Mitchells and Butlers and Funeral Services Provided Dignity on Monday the 10th of May. Grocer Morrison on the 11th. Compass, Spirax, Sarco, Coca-Cola Hellenic Bottling and National Express on the 12th. Burberry, Greggs and 3i on the 13th. And software giant Sage will round out the week on Friday the 14th of May. But for all of those, the company that looks to be capable of causing the biggest fuss in the week ahead could just be BT. The FTSE 100 stalwart is due to report full-year results on Thursday the 13th of May. The shares are up more than 40% over the past year, helped by the wider stock market recovery in the UK. For all that, though, the shares are no higher now than they were in 1985. That reflects the company's £12 billion net debt position, its £6.3 billion in lease liabilities, its £4.9 billion pension liability, plus how the firm is tightly regulated on one side, confronted by fierce competition from Sky, Virgin and Vodafone, to name but three on the other. And all the while, customers are able and willing to change service provider very quickly as they seek out the best value. Life is therefore just not easy for the telco, and this may explain why the firm's latest strategic announcement under Chief Executive Philip Jansen, who took the reins in February 2019, flagged that BT was in talks to sell at least a stake in BT Sport. Funding its liabilities, its capital investment programme and bidding for sports rights looks to be proving too much, in a final admission that the strategy outlined by Mr Jansen's predecessor Gavin Patterson has failed. His 10% dividend growth target's long gone, Mr Patterson himself is long gone, and the dividend's long gone, having been cut to zero. Sky 1, BT nil perhaps. Besides the strategic discussion here, and any update on who may replace the retiring Jan du Plessis as the company chairman, after widely reported but hotly denied talk of a rift between him and Mr Jansen, analysts and shareholders will focus on three key figures. The first is adjusted earnings before interest, tax, depreciation and amortization, or EBITDA, where Mr Janssen has guided to a figure of between £7.3 and £7.5 billion, down from £7.9 billion a year ago. That expected drop reflects lower revenues, thanks to the effect of COVID upon business customers, asset sales, and also ongoing declines in legacy operations like landline voice communications. The second highlight will be what BT calls normalised free cash flow. Here, Mr Janssen has steered analysts towards a range of £1.3 to £1.5 billion, well down from £2 billion last year and £3 billion just a few years ago. That's down to the combination of lower profits and higher capital expenditure as BT rolls out 5G mobile services and faster broadband through fibre to the premises, or FTTP. The third and final number of interest is the dividend, although it may not take long to discuss, as Mr Jansen's already said there won't be one. However, the CEO has also said he expects BT to return to the dividend list in its new financial year, so analysts and investors will be watching for any clues as to what sort of distribution they could expect. The current consensus analyst forecast is looking for around 7 pence per share in dividends for the year to March 2022. I hope that you and your families are all in good health and good spirits. Thank you for listening, and I look forward to talking to you again next week.